Well, let's dive into our voting interest model. This whole business combinations, right? This whole section, what are we dealing with? We're dealing with control over 50% ownership. Now, this is when you're going to consolidate, right? Another name for this whole section is consolidations, right? And well, when a parent company purchases over 50% of the voting stock of a subsidiary, consolidated financial statements are prepared and the voting interest model is used. So, the biggest takeaway here, this is what we're using. Before we saw 0 to 20% is fair value, 20 to 50 is equity, and now we're doing consolidated financial statements. What we use is the voting interest model. And I mean, really think about what this says, right? The voting interest model. We have a say in what goes on in this company. We have an interest, and generally that comes from like common stock, right? We own more than 50% of the voting stock. We can vote, we can say, we can determine what happens in the future of this company. So that's kind of the background with the name and all of that. Per the regulations of US GAAP, all majority owned subsidiaries, so these subsidiaries, both domestic and foreign, are to be consolidated except when significant doubt exists regarding the parent's ability to control the subsidiary. In this case, it may be downgraded to equity or just not included, right? Remember, in equity, we have the cost method and the equity method. Cost method is when you don't have significant influence. So this could include when the subsidiary is in legal reorganization or bankruptcy, right? When do you not use either the equity or the consolidation method? It's when you're in bankruptcy or there's severe foreign restrictions. So there's a couple instances in which we would not use the appropriate method. In this case, if we are owning over 50%, the appropriate method would be the business combination consolidation route. Now, here's a wonderful example. Here's a wonderful chart. Fair value method 0 to 20, 20 to 50 is equity, right? If we have significant influence. And then we use the acquisition method, we consolidate. Now, there's really no difference, right? The acquisition method is just another name for this, for consolidation, for business combination. For internal purposes, not external, typically equity method is used. Well, what's the NCI versus the controlling interest? Well, if I have, let's say 80%, if I got 70, if I've got even 50, right, that's the controlling interest. The NCI, the non-controlling interest, we'll see in a lot of these questions. This is what you are going to see. And they use the equity method because generally they have, in questions, you'll see it probably about 20% or so. And that's going to generally use the equity method. This is everyone else. This is everyone else who does not own it. So company A, right? Maybe we're Best Buy. Best Buy buys a small electronics company, but they own 80% of it. That other 20% is going to be this NCI, the non-controlling interest, because this is the interest that does not control any part of it, right? There is a whole company that controls 80% of it. So the NCI controls very small. The NCI is reported at fair value in the equity section of the consolidated balance sheet. So this might be a little strange, but when Best Buy buys a smaller electronic company, owns 80% of it, they need to list out this NCI. They need to list out the non-controlling interest, this other 20%, at fair value in the equity section of the consolidated balance sheet, separate from the parent's equity. All right. Lots of good points here. Now, this only applies when you don't buy 100%, right? If you buy 100% of the company, you own it as a wholly owned subsidiary, none of this is relevant because there's no NCI. Everything's controlled by you.